Interestingly, one price indicator associated with innovation is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. Now, this is not surprising in the late stages of a bear market. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are.
Hello and welcome to Money Talks. In today's video, ARK Invest CEO and CIO Cathie Wood updates about the market signals and economic indicators for the month of October, along with her outlook on cryptocurrencies, including Bitcoin. Cathie Wood also weighs in on M2 growth, inventory pileups, liability-driven investing, commodity prices, and why we believe the Fed is making a mistake as they base policy on lagging economic indicators. Make sure to stick around till the end of this video where Cathie Wood reveals that we are already in a huge recession and why the Fed is lying about it.
Markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is. Because bonds are selling off with stocks this time. So and one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline.
It has been difficult for Bitcoin and the cryptocurrency markets to start a strong, sustained recovery while the United States dollar is near its multi-year high and the U.S. equities markets are near their June lows. This shows that the sentiment remains negative and traders are not interested in taking on risk in their portfolios. The U.S. equities markets fell sharply on October 7th following the release of September's non-farm payroll data, but they did manage marginal gains for the week. The S&P 500 rose 1.5% and the Nasdaq Composite climbed 0.7% last week.
And so we looked at all of the indicators for this last month, just the last month, and we found 22 firm or strong indicators suggesting employment and inflation might linger at a higher than expected rate. And we found 22 weak indicators. Now, pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing more than any other. And we find that on the firm side, what they didn't like was core CPI and PCE at 0.6% month to month, even though the headline indicators were flat to down. The PPI core 0.4, and non-farm payroll, which came out today, pretty much in line, 263,000, but there was a drop in the unemployment rate from 3.7% to 3.5%. Now, the reason for the drop was the labor force, not employment. The labor force shrinking. Labor force participation ticked down. So I don't take that reason as seriously, because we do believe labor force participation will, on balance, continue to trend up, especially if we're in as weak an economy as we believe. So on the weak side, again, if the Fed were data driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there. I think in the U.S., among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession.
In the past few days, Bitcoin has managed to avoid a collapse even when the U.S. equities markets were being clobbered. This is the first indication that the selling pressure may be reducing and traders may not be willing to part with their holdings at lower levels. However, for a sustained recovery, Bitcoin will need some support from the return of the risk-on sentiment. Until then, volatile range-bound action is likely to continue, with certain altcoins offering trading opportunities.
So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now, that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or they're at the very least highly correlated. And that's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, and a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. So, we shall see.
So, do you agree with Cathie Wood that we're already in a recession? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.